Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, June 29th, 2024. Hey, how you doing? Hope you're doing well. Appreciate you coming by and watching my weekend review podcast. The format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily time frames and the weekly time frames. We're going to talk about when I entered the trade, why I entered the trade, what the setup was, what the combination or confluences of indicators lining up at that moment made me take the trade. And then most importantly, we're going to talk about how I am going to manage the trade going forward, whether the position goes my way or goes against me. You know, we have no control in the market. All we can do is create a plan with a good risk to reward ratio, enter the trade, and then manage what the market gives us. But the key takeaway is that if we are wrong, and we're going to be wrong a lot, that we can be wrong small. And if we're right, we have the potential for a big, large outsized trade, which you need to take care of all the inevitable losses that you are going to have. So we'll talk about how I'm going to manage the trade going forward. After that, we're going to touch on trader psychology. Always the most important skill in trading is the ability to create a plan and then follow that plan. But that comes down to trader psychology and about staying in the trade with the process that you have and not deviating from it. It's very, very important, everyone. You really need to get yourself a good trading plan, a good process, and then, of course, you need to follow that process as well. So we'll touch on trading psychology. After that, I have gone down through my master watch list, both on the daily time frames and the weekly time frames, and I have identified some trades that look good to me next week if and only if they get to the location that I'm going to go over here when I point out the new trades. You know, I'm looking for areas where there's confluences, where there's major support levels. Could be a 30 RSI, could be a 200-day moving average, could be 250-day moving average, 300-day moving average, V1, V2. You know, these are all the things that I look for, but at the end of the day, I'm going to look for the trade that has the best confluence. Maybe a V1, maybe an under 30 over 30, maybe a rejection of the 200-day. The more signals and confluences that happen at the same time, that's the best pick for me. And so, like I said, I will go through what I'm looking for, and we'll go through the levels that I'm waiting for that market to get to. And so I hope it's going to be helpful for you. If it is helpful for you and you find value in something today in the podcast, I really would appreciate it if you could hit the thumbs up button. It really does help out the channel. Okay, so let's get the U.S. legal disclaimer out of the way, and then we'll get rolling. Hang tight. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started with Intel. Okay, so I have a lot of different trades, a lot of different strategies that I'm using for these trades, and which is good. It's good to have a variety of strategies so that you're not concentrated on just one strategy. All right, so we'll go through here as we go along, and I'll show you the different setups. But here is Intel. So Intel, I got long Intel back on the 31st of May. Why? Well, for a variety of reasons. You see the green highlighted box here. Why is this green and highlighted? Well, this is what is called a bullish order block. This bar over here on the 10th was the lowest down close bar before we had a structure change to to the upside by taking out this swing high. So therefore, when you come back down into this bullish order block, the green highlighted area, this is a place where you should have some support. And as you can clearly see, as soon as we got into the green highlighted area, it's been major support. It has not gone lower than this. So I did enter here on the 31st of March at $30.29, and I entered, one, because we're in the green box, two, because we created what is called a V1. V1 consists of two bars, bar one, bar two. Bar two goes under bar one's low and then goes above bar one's close. I got in when it triggered and went above bar one's close at 30.29. So as soon as I get into this trade now, I need to do two things. I need to have what's called, I have two stops. I have an emergency stop and I have an end of day stop. The emergency stop down here, this red line, this is 2 ATRs below my entry. This is emergency stop. If it ever gets to this level, then I'm immediately out. I don't wait for the end of the day like I do for my end of bar stops. If it just gets there, that's it. No questions asked. The trade is over. And if I do get there the way that I position size, I will lose 1% of my total trading capital. The good news is that this only happens about 5% of the time. The other 95% of the time, if you have a loss, it will be because you close below your end of bar stop. And the end of bar stop is almost always much, much closer. My end of bar stop is a close below 29.73, which would be a close below the low of this order block. So we always want to concentrate on the losses first. One, with the emergency stop. Two, with the end of the day stop. All right, now let's talk about some profit, which is why we do this. So I have an orange line up here. This is exactly 1.5 ATRs above my entry. This is my trailing stop mode. So if I get to this trailing stop mode, doesn't mean I do anything initially. It just means that now if I get here, I'm in what is called trailing stop mode, which means now in the future, if I have a close below a previous bar's low after reaching trailing stop, I will sell half. This is a good way to tighten up your stop because you've now moved into the profitable area, significant profitable area. So, you don't want to give that back. And so if you do have a close below a previous bar's low, then that essentially moves all your stops up because you are selling half. Last thing is that everything I've talked about, the end of bar stops, the emergency stops, the trailing stop level, these are all considered defensive moves. And I also play offense, and I play offense by selling into strength, not the entire position, but a partial position if the price moves the value of 0.45 ATRs from the previous day's close. So like right now, we're at 30.97. So I take 30.97, I add the value of 0.45. The 0.45 right now is 32 cents. So I'd add $30.90, add 32 cents to it. That is my first profit target on Monday. I take my first profit target, add that 0.45 value again to it again. That's my second. And then I do that a third time. And so I always have 3 profit targets for the next day. And I have to recalculate these every day, but it's important to take partial profits. Oh, and I take 10% I take a 10% of how many shares I have left at the moment. So if I have 100 shares left, I'm going to take first 10 shares at the first profit target, 10 shares at the second profit, 10 shares at the third profit target. And I may not hit any. I've hit 6 or 7 before, but I always put into the system 3 profit targets for the next day, and that's playing the offense. So on the day that I bought it, 30.29, you can see it moved higher from where I bought it, so I took some profit targets. Next day we came down here, took a little profit target off, moved up here, no profit targets. Here on this gap, took another profit target. Now I am in trailing stop mode because I reached the 1.5 HR trailing stop level. And then we moved up here, took a little more off. And then on this day here on the 24th was the first day that we closed below a previous bar's low after reaching trailing stop level, I took off half of the remaining shares for a gain of, looks like, 0.98%. So that tightens everything up. It reduces my overall risk. If it goes crashing down, I've mitigated my risk by taking off half. And then on Friday, we had a nice move up and took some more profit targets. So the remaining shares that I have on this particular trade up 2.2%. So not too bad. Home Depot. All right. Well, Home Depot, nice little trade here. This was not a fair value gap or order block or anything like this. This was a simple deep dip buy approach. And by the way, if you'd like to learn more about my deep dip buy stock trading strategy, I have a great course on udemy.com. It's very affordable. It's 9.5 hours of video, and it's a great way to learn this approach. It's quite simple, but there's a lot of rules there. But that course is 9.5 hours, teach you step by step how to trade this, and the link to the Udemy course is in the description of this video. So I did get long Home Depot here on the 10th of June. Why? Very simple. Black line is the 200-day moving average. We closed under the black line, and then the next day we closed over the black line. So I entered here 332.40. Of course, I always place my 2 ATR emergency stop below. My end of bar stop is very simple, just to close below the 200-day moving average, giving me a very good risk to reward ratio. I have my 1.5 ATR trailing stop level here. Next day moves up. Then the next day really moves up. I believe I hit 3 profit targets on that particular day. So I've reduced my position size, locked in profits that the market can't take away from me, and we're also at trailing stop level. Next day went up a little bit, not much. Next day down a little bit. Then we moved up again here. Then we moved up again here where I took another profit target. Now, one of the rules with the deep dip by trading strategy is once you have one of these close under, close over 200-day moving average, and it moves up into the 65 RSI level. Now I initiate another stop, which is called the 5 EMA. This is this thin blue line here. So the rule is if I ever get to 65 RSI or above, and then I have a close below the 5 EMA, that's my signal, get completely out of the trade. And I did here on the 24th. Again, why? Because we were at a 65 or higher RSI level, and we closed below the 5 EMA. That's a good tight stop to use, and it's a key level, and we closed below, and I locked in the rest of the shares at a gain of 5.23%. And then the next day you can see, look, we had this huge move down, and of course I was really glad that I had gotten out. And I didn't get out because I thought it was too high or any news or anything like that. I just got out because the process I have and the rules that I have told me to get out under the 5 EMA. If you close under the 5 EMA after a nice big up move, it kind of tells you something has changed because that's a key level. So the remaining shares there on Home Depot, gain of 5.2%, and really good example of just a good basic setup: close under, close over the 200, position sizing correctly, emergency stop, and a very good risk to reward ratio. If I close below the 200-day moving average, just out of the trade for hopefully a small trade. But I have the potential for a nice big trade like I did here. So that's Home Depot. XLE. Okay, XLE, similar to Home Depot, deep dip buy. Close. Here's the black line, close under the 200, close over the 200. And again, I took this trade because it closed back over the 200-day moving average, came back down, tested it, but more importantly, it gave me a very good risk to reward ratio to that 200-day moving average. See how close I entered at 88.63. Look how close the 200 is below me. If it just simply closed even 1 penny under the 200, I'm just simply out of the trade. So I got in at 88.63, position size correctly, placed my emergency stop 2 ATRs below. My end of bar stop is where? Just to close below the 200-day moving average. Placed my 1.5 ATR trailing stop level up here. Next day, moved up strongly. I believe I hit 2 profit targets on that day. Next day, moved down a little bit. Next day, moved up again strongly, hit some more profit targets, and more importantly, we are at trailing stop levels. So now that we're at trailing stop level, if I have a close below a previous bar's low, I'm going to get out of half of the position. Next day, inside bar. Next day, we did close below a previous bar's low after reaching trailing stop level. So I got out of half of my remaining position. Oh, it's right here. For a gain of 2.24%, and I still have the remaining shares. And going forward, you know, if we get up into that 65 RSI level, then I will, the 5 EMA will come into play. If we get up to the 70 and reject the 70 RSI, then I have different rules for that. If we come back down and we close under the 200-day moving average, then I have rules for that as well. So no matter what happens here, I know exactly what to do. And, you know, that's why I'm suggesting to you, make sure you get yourself a trading plan. Make sure you get yourself a process where you take the emotions out of it and you use good technical trading fundamentals to tell you what to do, because you have no control of this market. All you have control is what you are going to do. All right, so remaining, got out of half for a gain of 2.24%. And right now, the remaining shares I have up a little bit more than that, up 2.83%. INDA. Okay, so INDA, you can see I have this red box up here. This is what's called an abandoned baby. And I love these trades. They don't always work out, but they work out more often than they don't. And the good news is in my experience, they work out 70% or higher. And when you lose 30%, right? But when you win, you make twice as much as you lose. So that's a good proposition. You know, for example, you win 70% of the time and make $2, or you lose 30% of the time and lose $1. It's pretty good. So an abandoned baby, a bearish abandoned baby. Why was this bearish to me? Well, is because here the day before the bar in the highlighted green box, we gapped up, and then immediately we gapped down. If you gap up and then immediately gap down and leave a gap with this bearish abandoned baby here, if you look out in time, more times than not, when that happens, you will be lower later. To the opposite, here's an abandoned baby to the upside. Look here. We gapped down, we gapped up. 70% of the time, when in the future, when you look to see what happens, you're going to be higher. Well, gap down, gap up. Were we higher? We're certainly higher than we were here. Now, again, it doesn't always work out. So when this happens, and I entered short here at $55.13, I place a 2 ATR stop, and I place a 4 ATR profit target. Like I said, 70% of the time, in my experience, I'm going to hit this. I'm going to make twice as much as I lose. So 70% of the time, I'm going to hit my 4 ATR profit target. 30% of the time, I'm going to hit my 2 ATR stop. So this one so far is underwater a little bit. I'm staying short until it hits that 2 ATR profit or 2 ATR stop or 4 ATR profit target. And this particular trade at the moment down 1.22%. Okay, UNG. Okay. Well, this is a short trade. It's worked out really well, you know, over the past couple weeks. You've heard me talk about UNG and looking for a short. Well, why? Okay, first of all, why was I looking for a short? Well, let me take you back to this trend line here. Do you see the trend line we have here? Nice uptrend, and then we broke the uptrend. So if you break the uptrend with a trend line, or you break the uptrend with a a change in market structure. Um, and interestingly enough, when you break a trend line, you almost always break market structure as well. We have this low here, and then when we broke this low, that changes market structure to the downside. When you break a trend line to the downside, that generally means you're could likely be going down. But when this happened, then here's an order block. Here is a bullish order block. Here is the highest bar close before market structure change. So when you break structure to the downside, the way that I trade is that I want to short rallies. If you break market structure to the upside, I think I got those confused. When you break market structure to the downside, you want to short rallies. When you break market structure to the upside, you want to buy dips. But this broke market structure to the downside by taking out this swing low, by taking out this trend line. So I'm looking for a short if we have a rally. Okay, notice the 200-day moving average, the black line. This is a good key level to base my short over. And so in addition that we're in this bearish order block as well. So we're in a bearish order block. We have a 200-day moving average. That gives me a good level to key my trade off of. So we rejected the 200-day moving average, came down. I did not short here because my risk to reward ratio wasn't great because we're pretty far away from the 200-day moving average. Next bar moved up and closed over the 200. So now I'm really glad because that would have been a loss. But the next day, we went above the 200, closed below the 200. Do you see how close the close was to the 200-day moving average? I got short here at $20.82. So as soon as I take the trade, I, as always, place my emergency stop 2 ATRs above because this is a short. And then my end of day stop is simply a close over the 200-day moving average, close over the 200. That gives me a very, very good risk to reward ratio. And again, I did not just short because it rejected the 200-day moving average. I shorted because we're in a bearish order block here as well. Remember, confluences. So I got short here at $20.82. I placed my 1.5 ATR trailing stop level below. Again, if it moves the value of 0.45 from the previous bar's close going in my direction, which is short, I take profits. So short at 2082, moved down, took some profits. Next day, I don't think I had profits. Next day, moved down nicely, did hit some profits, and take some more profits off, reducing the position size. And I got to trailing stop level, which means now in the future, if I get a close above a previous bar's close, I am going to take half off, which happened the next day. We had a close above the previous bar's high here, and I locked in 4.83%, but I kept half, luckily. So next day, we moved down, took some profits. Next day, not much. Next day, we moved up, no change. And then we've had this nice 4-day down move where on this day, I took some profits. Next day, took some more profits. Next day, took some more profits. And the next day, on Friday, took some more profits. So the remaining shares that I have on this particular trade, this has been a really great trade, obviously. This particular trade, remaining shares, up 19.45% on the trade. But again, I saw the break of the trend line. I saw the break of market structure by taking out this swing low. So to me, it identified that, okay, now we are in a bearish market structure. I'm waiting for a rally to short, shorted the rally with a good risk to reward ratio. And it's been a great trade. So that's UNG. And then last but not least is Tesla. Well, Tesla was a textbook setup and it's worked out very well. But the textbook setup is called a return to value V2. And if you'd like to learn more about V1s or V2s, just please go to my YouTube channel in the lessons playlist. And I have a video there on what V1s or V2s are. But let me bring your attention to the two green lines here. We have the top green line, we have the bottom green line. This is called a return to value. First requirement is you need to close above the value zone. Okay, we did that here on the 21st of May. Secondly, we need to have a pullback into the value zone. Did that happen? Certainly did. Third, we need some sideways motion, at least 2 bars. Well, we got a lot more than that, and that's great. And when those three requirements are met, close above, come back in, sideways motion. Now, if you get a V1 or a V2, it's a legitimate signal. Well, I took the trade here on the 12th of June with a V2. Bar 1, bar 2, bar 3. Bar 2 goes below the low of bar 1's low. Bar 3 closes above the close of bar 1. I got long here, 177.10. I placed my 2 ATR emergency stop below. I have my end of bar stop, which on a V1 or a V2 is a close below halfway of the washout bar. This is the washout bar. Bar 2 here because it washed out bar 1, or in other words, went below. So again, bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low. Bar 3 closes above bar 1's close. The stop is a close below halfway of the bar number 2. So right here, 170.150 with the 2 ATR stop below. So I got long here at 177.10. Placed my 1.5 ATR trailing stop level above. Right off the bat, exploded up to the upside, which was great. I believe I took 2 profit targets off. And the very next day, I get to trailing stop level. So good and bad on this trade. Next bar, we got to trailing stop level. Next bar, we closed below previous bar's low after reaching trailing stop level. Well, I locked in half the gains at 0.48%, but still positive and still took some profit targets on that big gap. Next bar, we rip up again, take some more profits. We kind of have some sideways motion here, sideways motion. And then on Wednesday, we had another nice big up bar where I took some more profits. Now, the key is, we are getting close to the 70 RSI. And so now I'm looking at 2 things. If we go up and reject the 70 RSI, I'm going to take half of the position off. Alternatively, here's the 5 EMA. This is the thin blue line. Remember, if I get to 65 or higher, right now we're at 66.23, so we're definitely higher. So the 5 EMA will come into play. So now this is very easy. If we go up and reject the 70 RSI, I'm going to take off half. If we go down and close below the 5 EMA, I'm just simply going to get out of the trade. So this particular trade with the remaining shares doing very well, up 10.48%. But this is a perfect example of a return to value V2. All right. Okay, so those are all the daily trades. Intel, remaining shares up 2.2%. Home Depot got out of the trade with a gain of 5.23%. XLE, remaining shares up 2.83%. INDA down 1.22%. UNG remaining shares up 19.45%. And Tesla remaining shares up 10.48%. Now let's go over to the weekly bars. I also like to trade weeklies. Weekly bars closes on Friday. And so really did well on the dailies. The weeklies not so great. They're down, but the key is they're down small. So let's take a look at IBB. I shorted IBB on the 17th of May. Why? Well, similar to what I showed you on UNG, natural gas, order block. Look, here's your highest bar close before market structure change, putting us into a bearish market structure. If you have a bearish market structure, what do I want to do? I want to short rallies if they happen. So this is almost exactly like UNG, but it's not. It hasn't gone down enough yet. So I got short here 136.69 because we rallied into the bearish order block, and also because we rejected the 200-week moving average. So I, of course, placed my 2 ATR stop above. I placed my 1.5 ATR trailing stop level below, and then my end of bar stop is simply a close over the 200-day moving average. So the next week, immediately it went above and against me. but closed below the 200, keeping me in the trade. The next week, we did move down. I was able to take some profit targets, but did not get to trailing stop level. Next week, we moved up again, got above the 200, closed below. Next week, we moved up again, went above the 200, closed below. Next week, again, tried to get over the 200, closed below. And ironically, this week, I thought for sure this week I'd get stopped out of the trade, but at the end of the week, it actually closed below the 200. So there are this area up here above the 200 so far, people do not want to own it at that price. So it closed below the 200, keeping me in the trade. And let's see. Currently down, but down very small, down 0.68% on the trade, but still staying in the trade because it closed below the 200. VIX, the next weekly trade. Okay, so I did buy VIX back on the 14th of June. Why? Well, I had a confluence of signals. We went under, this is a deep dip buy, by the way. We went under the 30 RSI, closed above it. And in addition, we had a V1. That was the confluence. Bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. I got long 11.21, placed my emergency stop 2 ATRs below. My end of bar stop is just simply a close below the 30 RSI. Right now we're at 30.27, so it closed above the 30 RSI, keeping me in the trade. So that's my end of day stop. So, right now 30.27 is very close to 30. Next week, if we just close even at 29.99, I'm simply going to be out of the trade. So this trade is down. About 2.93%, but again, staying in the trade because it's closing over the 30 RSI. And last but not least, on the weeklies is Meta, and very similar to UNG, very similar to IBB. Same thing on the weeklies. Highest up close prior to the break to the downside, which happened. So now I am going to short rallies, and I did short Meta here at 492.96 when we rallied back into the bearish order block. My stop is just new highs here, close above the order block at 532. And so this is down slightly as well, about 2.11%. So the weekly's not so great, but the key is that they are small losses. IBB down 0.68%, VIX down 2.93%, and Meta down 2.11%. So, it's interesting. I like to trade multiple time frames because you can see on the dailies we had great trades. On the weeklies, these are losses, but they're small losses. But sometimes your gains are on the weeklies and your losses are on the dailies. So anyway, I hope that was helpful looking at these trades and all the different strategies that I use. So let's talk a little bit about trader psychology. So like I said at the beginning of the podcast, the ability to create a plan and to follow that plan comes down to psychology and your emotions. And it is really quite important that you get your mind right so that you follow what the market's doing. This is from Trading Composure, really great channel over on Twitter. You can follow him at Trading Composure on Twitter. But let's see what he says. Place your trade. Maybe it'll work. Maybe it won't. You'll never know until it happens. But be fearless in the face of uncertainty. This is the ticket to success. Well, to make anything in the market, you obviously have to risk, right? And we want to, and so that's just part of the game. And you want to reduce your risk as much as you can. And how do you do that? Well, waiting for confluences, combinations of indicators, good support levels, good risk to reward ratio. So you always want to minimize your success. But the key is, I've had students where they just don't want to take a trade. They're scared to take a trade. Well, if you don't take that trade, you won't lose any money, but you're certainly not going to make any money. But you have to get the mindset of like, hey, look, if I don't take this trade, what trade am I going to take? It has, B1, it has a rejection of the 200, it has an under 30 over 30, it's in a bullish order block, there's a bullish divergence, right? All these things. But you have to be able to take the risk. It's a calculated risk, but it is a risk. And sometimes if you don't take that trade, it really is a bad thing because, yes, it may go against you, but you may have the potential for a really, really big trade. So you kind of have to get your mindset into what Trading Composure is saying here. Place that trade, position correctly. Maybe it'll work, maybe it won't, but you'll never know until it happens. Be fearless in the face of uncertainty. Don't be dumb about it. Position size correctly. Be patient. Wait for the confluences. Put that trade on, but don't be so scared that you're not going to take that trade because, yes, it may not work out, but if you've done your homework on the trade, if you're wrong, you're probably going to be wrong small, and if you're right, you could be right big. So be fearless in the face of uncertainty. That's the key. Fortune favors the bold, but you have to be specific and do your homework and do the numbers so that you're position sizing correctly, and that if you're wrong, you can be wrong small, and if you're right, you have the potential to be right big, right? So it's just like that trade on UNG, almost 20%. I didn't know that going into it, but I was patient. I looked at the charts, I looked at the technicals, I looked for the confluences, and I had a really good risk to reward ratio. I had the chance, if I was wrong, I could be wrong really small, but if I was right, almost a 20% trade. So thank you very much, Trading Composure. Appreciate that, and follow him at Trading Composure on Twitter. All right, let's get to the potential trades for next week. Now, I mentioned this a little earlier in the podcast, but, well, I'll put it this way. I have 9 symbols that I'm looking at for next week. It's possible that all 9 of them could trigger on Monday, for example. Does that mean I'm going to take all the trades? No. I like to score each setup, like give it a score. Like, for example, it has 1 entry signal, I give it a 1. If it has 2 entry signals, I give it a 2. If it has 3, I give it a 3. And then I pick the one that has the highest score. And, how do I base that score? How many signals does it have? What was the risk to reward ratio? How does it look on a higher time frame? These are all the ways that I narrow down the trade to the very best one. And this is what I teach in my private one-on-one course. And by the way, I do teach a private one-on-one course. It's a great course. I've taught people from all over the world, from absolute beginners all the way up to hedge fund managers. It's 15 hours. I do it at nighttime, in the evening time, via Skype, and I teach you all of the different trading approaches that I use. I teach you step by step everything you need to know to create a really good trading plan and a really good process. There's a lot of back and forth between me and the student. We do a lot of simulation trades. It does cost $1,750, but I'm telling you, it's worth every penny. I've traded for almost 29 years, and I'll share all the information, all the knowledge, and everything that I use to trade with you. And when you're done, you're going to be a great trader. So if you're interested, my email ends up in the link of the description. And then, financially, if you're not in the financial position to do the one-on-one, like I mentioned earlier, I have the course on udemy.com. That's a really great, affordable way to get started. And so the link for the Udemy courses in the description as well. So, okay, here is Adobe. Well, nobody wanted Adobe. Now everyone wants Adobe. I have this highlighted red area here. What is this? It's an order block. Here, back on the 12th of March, we have the highest up bar close before a break in structure. We move all the way back down. So now this means that if we get back up into this red area, this is probably a shortable area. My ideal location for this trade would be 573. Why? Well, if you go all the way back to the left here, we have this big down bar. If we rally back to halfway of this large down bar here on the 14th, there's going to be more likely than not always, but there's going to be some inherent resistance here. So anywhere in this red area is technically a shortable area, anywhere from about 563 up to 580. So I'm just going to have to wait and see. If Monday we bounce off the bottom of this bearish order block in reverse, I might take the trade there. If it moves higher into the order block, I might just wait till it gets to 573. If it goes all the way up and hits the top of the order block and then comes back in, I might take it that way. And then my stop would simply be a close above the high here of 580, 535. This would be the highest close here. And then, of course, I put my 2 ATR stops. So with these order blocks, it gives you a lot of latitude on how and when you want to get out, get in the trade. But unfortunately, I don't know what's going to happen. If I could see what it looked like on Monday, I may say, okay, I'm going to take the trade. But we're not there yet. But suffice it to say, anywhere in this red box here from about 563 up to 579 is a shortable area, and I'll just have to wait and see. But that's what I'm looking for. I mean, obviously we've had a huge move up here, but the key is if I do get in this trade, and wherever I get in this trade, I'm going to place my 2 ATR emergency stop above, and then my end of bar stop for sure will be a close above 585.35. So this is kind of a zone trade. This is the zone. I'm just waiting to see what the market action looks like when I get there. Bitcoin, BITO. Wow. Big up move, big down move. Everybody had to have it over here, chasing. And now we're back to the 200-day moving average. Well, look, 200-day moving average is a good area to look for a trade. Right now we're under it. Monday, if it closes over the 200, I may consider getting in there. Why? Well, because the 200 is now below me as support. It doesn't mean it has to hold the support, but it's better to be in a trade when you have major support below you than above you. Right now, you're below the 200, so you have it above you. So some different possibilities here. If we close over the 200-day on Monday, potentially I'd take the trade. If we go lower, we have two other key areas here. We have the 250-day moving average. We have the 300-day moving average below. One of the best confluences that you can have is a major moving average along with a 30 RSI. Again, this is deep dip buy. So we're at 34.45. I would imagine, depending how fast we get down, if we got to the 250-day moving average on BITO, that would line up with a 30 RSI. So, we just need to wait and see what happens here. But Monday, if we close above the 200, potentially get in that, use the 200 as my stop. If we go lower than a 30 RSI and the 250-day moving average right here, would also be a good place for me to potentially put a trade on, as long as it gives me a good risk to reward ratio. We don't know those levels. They're serious levels. A 30 RSI and a 250 moving average would be a serious level, but it still doesn't have to hold there. But the key is we have that line in the sand. If it's above the 250, I'm in. If it's below, I'm out. It's pretty simple, but in trading, it's usually best to keep things simple. Next is Budweiser. Well, it's amazing, right? Look, nobody wanted it. Everybody wanted it. Now we're back into the nobody wants it level. But right now, I am kind of interested in Budweiser for a couple reasons. You can see the green area here. These are fair value gaps. And then the blue area down here, this is a bullish order block. Doesn't look very bullish, right? But this was the lowest close before we had a structure change to the upside. So basically anywhere in this green and blue area here, I would consider a buyable area, but we still need a signal. What would the signal be? Well, we're below the 250, below the the 200, below the 300. Well, a 30 RSI, we're at 3460 right now. A close or a rejection of the 30 RSI would be a completely legitimate level, an entry signal, especially considering that we are in the bullish fair value gap. Another option would be an abandoned baby. Look, we gap down strongly on Friday. Monday, if we gap up, then this will create an abandoned baby. That would also be a legitimate signal. Abandoned baby or island reversal. And if you'd like to learn more about abandoned babies, island reversals, go to my YouTube channel, look at the lessons playlist. But there's abandoned babies, bearish and bullish all over the place. Look over here. This was a bullish. Make this blue. No, I'll make it orange. Here's a bullish island reversal. Did it work? It sure did. Here is a bearish abandoned baby. Did it work? I would say so. So Budweiser seems to be a good market for abandoned babies and island reversals. So we are setting ourselves up for a potential bullish abandoned baby on Monday. Maybe, maybe not. So if we get a bullish abandoned baby or island reversal, especially considering it's in the fair value gap, I would consider taking that. If we go lower and reject the 30 RSI, that would be a potential entry for me as well. DoorDash, DASH. Well, that 200 is pretty obvious. It may get there, and I always like to buy off of the 200-day moving average, mainly because it gives me such a good risk to reward ratio. And what I like about this is that, yes, we are going lower, we're dripping lower, dripping lower, dripping lower, but we're doing it very slowly, which is better than just boom, right down to the 200. So I am looking for potential rejection of the 200 next week. Right now, the 200 is 106.88, so we're getting pretty close. And again, it may not hold if it rejects the 200-day moving average, bounce, intraday rejection, close under, close over. It may not hold, but at least it gives a good structure for the trade where the line in the sand is, hey, if it rejects the 200, yes, I might enter it, but if it closes below, I'm just out. In addition to that, looking at the MACD here, very strong red MACD here. Now MACD, even though we're lower than over here, is red. A lot of things with that. Double bottom bullish divergence. It just improves the quality of the trade. Basically, it just means that the selling momentum was very strong over here. Now it's definitely not as strong here. And if you run out of selling momentum, the implication is you're going out. So for DoorDash, looking for a rejection of the 200-day moving average. FXY is the Japanese yen. Oof, man, this has been something. The yen has just gone so low and so low and so low. Well, I've highlighted the green box here. What I'm pointing out here is Monday, if we gap up and create an island reversal, a bullish island reversal, then I would consider getting into FXY. But at this point, about the only thing that would get me into FXY here is a bullish island reversal, or if we go lower, maybe a potential bullish abandoned baby. Home Depot. Okay, well, I had this trade already, and I got out, and we already went through that earlier. Close under, close over the 200 with a good risk-reward ratio. Just moved up, 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 lost the 5 EMA. Well, potentially hitting a double on this trade. If we come back, and I don't know if we will, obviously. I don't know if any of these things are going to do anything. But if we move back down and reject the 200 again, I would potentially get into Home Depot again. I mean, it respected the 200 over here. It doesn't mean it has to in the future. But if it respected it in the past, it's more likely to. So it's not even really close. 200's at 332.91. We're at 344.24. So I'm just saying if it does next week potentially come back down and retest the 200 and give me a good risk to reward ratio, I would consider taking the trade. MasterCard, MA. My gosh. What is going on? Nobody wanted it. Everybody wanted it. Now look, we've had a huge move back down, but we're coming down to a key level, 200-day moving average. I haven't talked about deep dip buys for seems like a long time because everything's been going up, but things are changing and we are coming down to these major support levels. So the black line 200-day moving average doesn't, if it rejects it, it doesn't mean it has to hold, but it gives me a good risk to reward ratio, gives me a good line in the sand. So 435.15. So we're about $6 away from it. Don't know if it's going to get there, but if it does reject the 200-day moving average, I would consider getting long MasterCard. NVIDIA. Okay, even the mighty NVIDIA has changed market structure based upon the trend line break. You see the trend line here? We had this low, run it out in time. On that big reversal bar day, we broke below the trend line. Well, if you break below the trend line, that in the way that I look at the market puts it into a bearish market structure. What do I want to do? I want to short rallies. If you're in a bearish market structure and you rally, you want to short the rallies or short the rips. So the real key level here on NVIDIA for me is this order block between 131.30, 136.68. This is a shortable area. My stop would be a close above the all-time highs here. And the ideal location for me would be 134.80. Why? Because that's big down bar. And if we rally back to halfway of that big down bar here, you're going to have potentially have some inherent resistance. So again, when you're dealing with order blocks, there's a lot of different ways to approach it. We could just literally go up, try to get into this order block and fail. That would be one way to enter for a short. Like I just said, getting up to halfway of that bar there, I'd like better because now you have a better risk to reward ratio. The problem is if you go up to the bottom here and it rejects, yeah, you can get short, but you have a lot of range to your stop. So the higher, the better, essentially. But if we go significantly higher on NVIDIA and get into this order block between 130.78 and 137, somewhere in this range here in this red area, I would definitely consider getting a short because, when you break with NVIDIA, because it's so strong, when you go up so strong like this and you break, almost always you're going to get buyers, right? You're going to get buyers, but and that's going to drive it up like it has a little bit. But if you go back up and it fails, then these buyers that bought the dip are probably going to bail. That's going to add selling pressure. Shorts are also probably going to come in if it fails. So you have two groups of sellers, and that's why a lot of the time you'll get a big down move. So what happens is you break market structure, you go down that dip spot, you rally. If that rally fails, that's when you get a big down move. That's why I always like to short lower highs, and I don't like to short the first dip down because that first dip down, just like here, gets bought. So again, on NVIDIA, looking to short in somewhere between 130 and 136.85, somewhere in this red area. Last but not least is RIO, RIO, again, back down to the 200-day moving average, the black line. We're getting pretty close. On Thursday, it looks like we bounced, and it held. I didn't take the trade. Interestingly enough, this is an abandoned baby. On Thursday, on Friday, I didn't notice that. See, we gapped down, and then we gapped up, and it happened to the 200-day moving average. So that's pretty interesting. So anyway, I will be looking for another test of the 200 moving average here at 65.55. We're at 65.93, so pretty close. Yeah, I definitely could have gotten in that trade on Friday. I just didn't see it with the bullish abandoned baby. So anyway, those are the dailies, potential setups for next week. And then let's go to the weeklies. And again, on the weeklies, next week, potentially all these could trigger, but does it mean I'm going to take them all? No, I'm only going to take the one that has the highest quality score, the most confluences of signals, the best risk to reward ratio, how it looks on higher time frames. These are all the important things that you really should use and look at to narrow down and decide which trade to take. And again, this is what I teach you in my private one-on-one course. So AGQ, which is silver on the weekly, I've talked about this for a few weeks. We just haven't got there, but that 200 week moving average, the black line, if we reject that next week, this would be a potential entry long for me. Alibaba. Okay, I've talked a lot about a lot of bearish order blocks. This is a bullish order block. Look, this is our lowest down close before a break to the upside. So we closed down, we broke to the upside. If we break structure bullish into a bullish structure, I want to buy dips. Okay, well, this one's pretty good, actually. I like this here. The bullish order block is from $70.56 down to $66.74. So next week, if we come into that level, anywhere between, what did I just say, 70.62 and 67.02, this is a buyable area in the way that I trade. The ideal spot would be, for me, the ideal would be 68.70. Why? Because it's halfway of the washout bar on the V2. That's going to have some inherent support. So I like BABA. I do like BABA, but I only like BABA from 70.62 to 67.02 and ideally 68.85. But who knows? If we come down, bounce off of the bottom of that bullish order block, that may just be the entry. My stop would just simply be a close below the order block there, the low of the order block at 70.54. So I think there's some potential in here. You know, it's always kind of hard to buy when things are going down, but keep in mind, we broke market structure strongly to the upside. If you drew a trend line, we broke the trend line. So a lot of times you'll come back test the trend line or back test the order block, and that's what I'm looking for on BABA. CRM. Okay, Salesforce. Well, we're back to a bearish order block. Here on the 17th was our highest up bar before market structure change. Therefore, this becomes a bearish market structure. Therefore, I'm looking to short the rally. But the rally location would be somewhere between 275.49 and 291.15. So a lot of range there. We're not really even close. I don't know if it's going to get there, but the ideal spot would be about 278 if we continue to rally up here. Why? Again, biggest or down bar. If we get to halfway of that down bar, there'll be some inherent resistance, and in addition, in the bearish order block. So just to wrap this trade up, just in the red area here, somewhere in here in the bearish order block would be a decent risk to reward ratio to short, and then the close would just be a close above the high of the order block at 290.02. GDX, which is gold miners. Again, I've talked about this, the 200 week moving average, the black line would be the spot. And the nice thing about this 200 here, it dovetails with these previous highs. If you break over previous highs, that was resistance. And if you break above that resistance, now it becomes support. So there's a nice confluence there of the previous highs, the support, and the 200 week moving average here as well. So a move down to the 200 moving average or 200 week moving average would I would potentially take a look at getting long this. IWM, again, same 200 week moving average. The black line, you can see last time on the 19th of April, we came back down. We tested it. We held above. The market respected it, moved up. Does it mean it's going to happen this time? I don't know. but there's a better chance. If it happened in the past, it will happen again. But we're not there yet, right? It's at 195.45. We're at 202.91. So it's not there yet. Not interested unless it does come down and we reject it. McDonald's, Mickey D's. Boy, these consumer stocks really weak. Home Depot, um, Nike. Did you see what happened to Nike on Friday? Walgreens. These consumer stocks really, really weak. What does that say? Well, it says there's a problem with inflation, a problem with consumers wanting to spend. That's why you have these things down so much. But nonetheless, 200-day or 200-week moving average 244.87 is the area. I've highlighted it here in black. Hey, if we come down, reject that 200-week moving average, that would be a good risk to reward ratio. Doesn't mean it's going to hold, but it gives you a definitive line on the sand and buying McDonald's while it's on sale instead of chasing it all the way when it's up here. 200-day is a good level, or 200-day or 200-week is a good level to key that off of, but it's not there yet. If it does get there, I consider taking the trade. Pfizer, okay, well, Pfizer's a little different here. We have had a trend line break to the upside. We have had a market structure change to the upside. If you have a market structure change to the upside, what do you want to do? You want to buy dips. So what I'm looking for on Pfizer here is about 26.15 to about 24.87. And this is an order block too. Lowest down bar before market structure change. Those are the levels that I just gave you. The high and low of the order block, that's the green area here. MACD, we have a double bottom, bullish MACD divergence. These are all positive things, but I need to wait for it to get down there. Ideally, probably the real spot here is about 26.15 because it's halfway at this big up bar. If you have a big up bar and you come back to halfway, that's a decent place for some inherent support. And that also dovetails with the top of the order block. So, yeah. High is 26, yeah, 26.15 is about the area that I'm looking for. But again, we've broken market structure to the upside. When that happens, you break to the upside, a lot of time you'll come back and test. You have a trend line here, it broke above it. A lot of times it'll come back and test that trend line before you have a move up. So I do really like this Pfizer trade, but again, it has to come back down into this bullish order block. And then last but not least, XLU. Okay, 200-week moving average is right there at 66.56. We're at 68.14, so it's not there yet. But if it does and reject it, then I'll consider taking it. So, really, the key takeaway here, everybody, is just to identify your levels, wait for the market to get there, and if it does get there, then potentially take the trade. If it doesn't get there, then wait for a market that does get to the level that you want. Doesn't mean that level is going to work, but being patient and waiting is really going to improve your trading. One, being able to identify what the levels are, and then be patient and wait for them to get there. So I hope this was helpful today. If it was, like I said, I really would appreciate if you could hit the thumbs up button. Like I've mentioned a couple times in the podcast, if you're interested in private one-on-one lessons with me, I teach a great course, 15 hours. I'll teach you everything I know, teach you all the strategies that I use. I really think you'll be happy that you took the course. I know you'll be a better trader. Again, the online course at udemy.com, the link's in the description there. That's a really good place to start as well. But I always like to leave off by, please try to go out and do something nice for someone today. Really would make the world a better place if we could all do one nice thing for another human being. If you could also do something nice for an animal, that would be great. I was raised with many, many animals. They appreciate acts of kindness just like we do. So thank you so much for being here. I hope you enjoy the rest of your weekend. And God willing, I will see you next week. But take care, everyone. Thanks again. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.